thank Funded Here and Anin for the invitation to address what I consider to be a very hot topic, which is that of the pricing or valuation of technology and know-how. Now, for convenience, I shall simply refer to technology, but the issues are really quite similar for know-how as well. Let me begin by sharing some of my thoughts and observations on the challenge of ascribing the right value to technology. Technology, know-how, patents, trademarks, they all fall under the category intangible assets. So first, let's take stock of the rising prominence of intangible assets in the next slide. So why is there a need to focus on intangible assets? Back in 1975, intangible assets accounted for an estimated 17% of the market value of the S&P 500 stocks. In other words, less than 1/5. But as of now, this has jumped to an estimated 84%, which is essentially reversing the mix and reflecting the decline in significance of the tangible assets, things like real estate, equipment. And if we were to just take a look at the top 5 tech companies, we'll see that they account for a massive 1/5 of the entire market cap. So intangible assets are now, showing up in a much bigger way. Now, the other two trends that I would like to speak to are that actually pre-COVID, these two trends were already gaining prominence. The first has to do with how we traditionally would refer to sectors of the economy. So we will typically say manufacturing, services, and so on. But the lines have already increasingly blurred. So it's very common these days to hear the reference manufacturing services. In other words, there's a shift away from hardware towards software. And the other trend, which is, I'm sure, familiar to all of you, is that of technology and how it continues to relentlessly drive the definition of business activity, sectors, and in fact, the economy at large, of which data, the ownership, as well as the ability to perform data analytics is, I believe, the new animal to be addressed. So we can see that the pendulum is really swinging very purposefully away from traditional assets, predominantly the tangible assets, to the whole new world that we call knowledge. The focus is increasingly more on the valuation of not just brands' know-how or intellectual property, but also the potential of such intellectual property to generate further growth and innovation. Let me now just track the invasion of technology in the next slide. So as we can see, slide 3, please. So this is just a simplification of where or how technology has, in a way, been really pervasive. In fact, right now, it's in every aspect of our lives, as well as the catalytic role that technology plays, because it continues to spawn even more innovation, innovation of goods and services that we never dreamt were possible. The older ones among us will remember how technology was represented by simply automation, the use of machinery to achieve greater productivity. That is, of course, to also replace human labor, manpower. And then scale was achieved as technology allowed humans to replicate tasks or manufacturing ability without constraints. As a consequence, the expansion of the marketplace became real. With technology comes portability too. So products, and to a large extent, services as well, can now readily travel. So in short, they can be very market ready, even if localization or licensing is required in a different market. And unless the market is tightly regulated, cross-border markets are now a real possibility. So just think of online retailing as a good example. And fourthly, data used to be simply collected for record purposes, but now data is something to be valued. The better the data analytics, the more valuable the data that is collected. So how should we value technology as a consequence? Let me now just go on to the next slide and talk a bit about, a quick scan of who the various stakeholders are. So you can see on the one side, the creators are really the ones who may be of varying scale. So you could be they could be very small entrepreneurial startups, or they could be sizable R&D teams in the multinational companies. And in between, you have the consumers of products and services, as well as the business partners who provide these products and services. And then you have the intermediaries, who are the bankers, the accountants, the lawyers, who all play a very important role in determining the value of such IP. And not so obvious is actually the role of the government. In terms of supporting the evolution of valuation principles and standards as part and parcel of promoting technology and innovation, because there's not much point encouraging the promotion of technology if you can't describe what sort of value they actually should carry. So what are some of the challenges when it comes to valuation of technology? So if I can go on to the next slide. So what are some of the challenges? In one word, plenty of challenges. And I apologize for this very busy slide, but it really represents how challenging valuation can get. And let me just begin right at the middle top and then go clockwise. So the very nature of the type of assets we're talking about is seldom physical, and therefore extremely hard to assign a value. There remains a gap with accounting standards, which is why there's always this continuing debate around goodwill. How do you account for goodwill? How do you treat goodwill? Goodwill being the difference between what is paid for and what's carried in the books. And of course, the greater the uncertainty, the larger the goodwill, even if one believes in the potential of the know-how. COVID, for example, is an excellent illustration of how the increase in uncertainty can have such a huge bearing on goodwill. Values are typically derived from a whole host of assumptions, in fact, layer upon layer of assumptions. And this could be, for example, the valuation of technology IP on how rare it is, how unique it is, how scalable it is in terms of use, as well as, of course, the underlying economic conditions. So obviously, in good times, the valuations will go through the roof. In bad times, the valuations are a lot more subdued. There are pockets of valuation standards for intangible assets, but these are not widely imposed nor adopted. So that creates a bit of a challenge as well. And then meanwhile, as I'm sure you all have encountered, we see valuations of so-called innovative tech businesses, which are pre-revenue or loss-making, but essentially valuations that challenge logic or even sanity. Hence, you often hear the remark that beauty is in the eyes of the beholder. But I should add that many beholders obviously have quite a clear way of valuing intangible assets. So in some, not having traditional precedents means that apart from the usual business risks, investors also have to assume valuation risks as well. I would like now to focus for a moment on just the value of data, which is fast becoming the anchor of many a business valuation. So if you can bring up the next slide, please. From a user's perspective, one needs to go beyond the typical questions around data integrity, how it's collected, how it's secure, and so on. Data is non-linear in value and depends very much on the use case. For example, between tollgate usage and online purchases, there are obviously differences to scale. If data is simply commoditized in value, then all these subtleties in terms of scale and use would be lost. An example which I'm very familiar with and which I like to sort of recount here is that of smart wearables. So beyond the hardware or devices which measure vitals like heartbeat, body temperature, SpO2 for COVID purposes, or activity, amount of sleep, the platform which triangulates the different data points and trends to produce alerts, warnings, is really where the true value of data lies. It is clearly exponential when AI is applied to the interpretation of data as well. Beyond information and tools to crunch data, there should be an understanding of linkages between data points or patterns that give greater predictability of trends or that will support an ability to predict consumer or to even shape consumer behavior. So what should creators focus on? So the next slide, please. So my advice to creators is that you should try your level best to preserve ownership of technology and to monetize as much as possible. Now, monetization actually can fund further innovation. So the recycling of capital is extremely important in innovation. So how do you preserve your ownership? So there should be protection via the registration of patents, trademarks, or intellectual property as a whole. And this will be extremely critical. It can be obviously inordinately expensive for a creator to register, the many inventions. So a creator has to really weigh quite carefully which are the important ones, what to register, or where to register if the exporting of services is conceived beyond your home market. The second thing, which may not seem to be so obvious, but which I would encourage all stakeholders to do, is to support or push for the establishment of valuation principles and standards so that your innovation won't be subject to arbitrary valuation adjustments. So push for the establishment of a valuation profession. There already exists many people who are performing valuations of some kind. So push for that to be professionally recognized, certified, and that will help with stating principles and the whole framework. This will, in the longer run, help facilitate proper valuation and facilitate your eventual monetization when the time comes as well. Innovation is vulnerable to regulatory risks, especially if your technology straddles more than one domain, and especially if the domains are regulated areas like financial services. So fintech is actually one of those examples where you straddle both, and then you wind up being, having to bear the brunt of perhaps a rather angry regulator. Or your innovation could be so successful that it reduces the competitive ability of the existing players. Then that would also attract the attention of the antitrust players. So the antitrust regulator might then start to check your progress. So being watchful for regulatory risks is extremely important as well. Let me now just talk a bit about what about the users of valuations and what should they focus on. So on the next slide, most users would focus on the verification of value. So they will look at the methodology, they will look at the veracity of the inputs, and they will assess the potential of these intellectual property, which is where it gets especially tricky. And this is actually frequently the source of what we call irrational exuberance and insane valuations, because the assumptions are like where people vary substantially. Most users will check for the degree of protection of technology or IP, and also assess key man or innovator risks as well. Unlike tangible assets, intellectual property tends to require smaller amounts of capital. Unlike tangible assets, location is really no longer key to the ability to produce a service. For intangible assets, the focus is therefore more on human capital and the ability to continue developing more intangible assets and IPs. Like that, for like my sort of urging for the creators, users should themselves also collectively aim to establish a very high level set of valuation principles, and then complement it by local methodologies or customization as necessary. The principles should cover the capturing of value add, scarcity value, the relevance to regulations, and so on. Now, otherwise, the banks will continue to find it extremely challenging to extend credit away from the usual lending model, which is to find a collateral in a real asset. So in the same vein, users should push or urge the governments to try and close the gap with accounting standards. So accounting standards have come a long way, where now there's global adoption of at least one or two, set of accounting standards. Most governments have imposed that on companies, and therefore, that there's like a common accounting language. The same, I feel, should be done for valuation standards as well. So ultimately, effort must be directed at building trust in such valuations, which necessarily means building, empowering, promoting the whole valuation profession. This is something which local governments are really in a much better position to do than any of us who are in the economy itself. So I'll just stop here, and I look forward to hearing your views and questions. Thank you.
Thanks so much, Mrs. Lim. So I'm gonna take over, guys, from here in terms of moderating the sessions. And as Daniel mentioned, there's a chat on the, I don't know, left, right side, up side. I don't know exactly what it is. On my side is on the left side, and you can ask questions. I already received a couple of questions, I think, from shy people who didn't want to put it in the group, message me privately, but feel free to also to ask directly in the group. I think we are quite a good number of people, so we can make it quite intimate. There's no wrong or right questions. So really feel free to ask everything. Mrs. Lee, thanks so much for the presentation. And I actually already have 1, 2, 3, 4, 5, almost 10 questions for you. But
okay.
I will start with the first one, actually. And I will rephrase a bit the questions, but you talk about the value of data. And the question for, I think, probably one entrepreneur is, how do I access this data, right? So I guess a lot of entrepreneurs are not necessarily, in the small circle of what is going on. A lot of valuation are being made, using comparables. And this requires access to data, right? And if you are even a small investor, a small VC, an angel investors, you are also sometimes disconnecting from this data. So what would be your advice to access this valuable data that will help any stakeholders to define a valuation?
Okay. I think there are two aspects to data. The first is actually data as a business, which more and more companies are using. So they not only sell you data, they tell you that particular segment of customers like your type, or they prefer this sort of goods and services. So that's data as a business. But if you're referring to data to help you make a better sense of like whether you're valuing your own business or whether you want to invest, then a lot of it would require a lot of understanding of the underlying technology and know-how. You really need to have a handle on the domain knowledge. So it's a bit of the old economy and the new, right? So let's say you do retailing. Now you have online retailing, which requires you to understand the whole basic business of retailing, but at the same time also what online can do that will help you sell better. So, so if you need to evaluate how how to value someone who comes to you to tell you I'm a great online vehicle or platform, you first need to know the business of retailing. If you are not in that, or if you are in that, then how can this platform actually help you? So I would say that the underlying domain knowledge will be extremely important.
Mm-hmm. Perfect. I do have these actually interesting questions I actually get all the time based in Jakarta. So there is usually a huge difference between the way investors value technology-driven, technology-enabled organizations that we call startups, and more like traditional brick-and-mortar businesses, right? So we have actually a real case at the moment with Anin. So it's like we have on one side a restaurant, and on one side the same business, but that sort of be turned into a food innovation company. And the valuation typically jump just because the pitch or the narrative was very different. So the question from the audience is, who gets to decide what is innovative technology enabled? Mostly using the example of WeWork, that could be seen as a traditional real estate model. On one side, that should be valued that way. And the other way is like an innovative model, but a lot of stakeholders don't necessarily understand what is technology driven in the model of WeWork. And so who gets to decide what is technology and that is driving this valuation up?
Right. So maybe if I can use the example of the F&B business. If you're a top-notch chef and you have only one restaurant in Jakarta, it's not possible to replicate that and sell online. For example, either the quality will be different or the whole experience, dining experience is different. So the scarcity value is very high. So this is one where technology still has a long way, to influence the value that the chef is bringing. But you take online grocery shopping, that's like the other end. It's non-unique, it's easily replicable. So then that's where the technology platform becomes of a great value. So I think in many of the examples, one would have to see, if you provide very unique services and you believe that the market wants it, then obviously you're in a slightly better and stronger position to dictate the value, that you be prepared to stop part a stake, in your company. But if yours is something that is easily done by another person down the road, then obviously you would negotiate a little differently. Yeah.
I understand. I will take the questions from Nicolas. Thanks, Nicolas, for the question. So first, thank you for the excellent and clear presentation, Mrs. Lim. So I just read the questions and probably add some of our clients are thinking that the highest valuations are coming from the US, right? So the question is Singapore trying to adopt some common standards on valuating technology? I guess basically to drive some valuation up. We have also the same questions, I guess, related to this is there's a certain difference between valuation practice in Singapore, or also in, I guess, in general in Southeast Asia and other largest market like China or the US, right? So how basically do you see the difference being applicable in these different regions?
So that's a very good observation in terms of distinction by size of market. So the US and China, as you have mentioned, are really very big markets that hold their own. So if you have a great product and you're able to scale using technology, the US and the Chinese market would be one that you can just go to market quickly and you can see the results straight away. Now, in contrast, Southeast Asia is a collection of so many different countries and so many different markets. And the demand functions are actually quite different, either because of different cultures or different stages of growth and so on. So it's actually a lot more difficult, even as ASEAN tries to build a common market, it's difficult because it's not homogeneous. So that's why Singapore is trying very hard to be the valuation hub, because if we can at least get standards going, valuation standards going, then hopefully people will just take business risks, you know, whether you believe in the assumptions or not. But you don't have to take valuation risk because you value it differently from the way I value it. But valuation standards are probably where accounting standards were almost 2 decades ago. So accounting standards started that way as well, trying to get everyone to agree on one. It's never perfect, but at least if we agree on one, we can begin to talk the same language. So this is what the International Valuation Standards Council, which I'm a member of, is trying very hard to promote global standards setting.
Mm-hmm. So a question related to this actually was also from the audience. Sometimes we see this bubble being formed in different markets, right? There used to be the dot-com bubble, and then some actually economists and predict another bubble in some of these very hot markets here. How actually standards are being sort of implemented and forced to avoid this bubble to be formed, especially in the context of Singapore or Southeast Asia?
You know, when the market is very hot, nobody wants to listen to reason. Mm-hmm. And nobody wants to go back to properly defined standards and so on. I think what everybody, as they chase something or a theme or whatever, they just hope that they are not the last person standing or holding the baby. Mm. If they can get it out of the way, they just turn it around, they make that, you know, X%, they'll be happy with it. But they just have to be sure they are not the last one holding the can. But that is, of course, we all know, very, very risky because you can literally lose your pants, you know, doing that. So in a hot market, it's very hard, even if we get to the stage where we have good standards, you know, being practiced and defined, it's very hard to buy good businesses during hot markets because everybody is trying to bid, you know, for it. Now, but if you are buying a business for strategic reasons, then I think the considerations might be quite different. For example, if you have a very good product, but you want a technology partner to help you, you know, open up markets and so on, then I think your valuations would have to encompass that, because the extra value that you will create for your own company would be what you might be prepared to pay as a premium to what others might be prepared to pay. So it depends on the reasons for your investment.
Yeah, makes sense. I'm going to keep sending you questions. Actually, questions from Virginia that would be very interesting for I think different audience, but especially entrepreneurs. Is we see usually general valuation principle being applied to different type of businesses, different type of verticals, right? So the valuation, you know, in the healthcare versus retail is different. e-commerce versus marketplace, enterprise SaaS versus, I don't know, like a logistic model. So how do you basically sort of find your way into all these different valuation being applied? And I think two questions is, do you believe there should be a certain level of standardizations, or actually the variety of valuation is good for the industry? And how do I, again, it comes back to these questions I get on my chat is, how do I know, how to get the right valuation methodology, data comparables for my specific business? Because it becomes kind of a very complex process as well.
Yes, so we have the challenge of, in a way, sort of limited use of valuation standards at the moment. But let's put that aside first. It's really how, what I call the overlapping of domains that's creating a real challenge. So let's take healthcare. Since I'm on the board of a bank, I can tell you how the bank would typically look at your business model. At the end of the day, the collateral for lending you something would ultimately be the physical buildings, and maybe the fact that there are a few good doctors, and so on. But now you have, say, telemedicine. Then how do you value the technology part of that telemedicine? Because obviously for it to work really well, you actually no longer need great hospital buildings. You still need good doctors, but you need a great system to link, people in the rural areas to the doctors. So the technology itself becomes the price, becomes an important link. But bankers, for example, will have a real nightmare. How do I value it? Obviously, it's important because it brings access of healthcare to the rural areas, but there are no hard buildings for me to put a security on. So this is where it will evolve over time. So I don't think valuation standards will, once they're agreed upon, will actually be static. In fact, they themselves will be revised more and more so than, say, accounting standards over time. But it's far better to at least have a framework than to each of us just take our own piece of paper and then we start, deciding what we want.
So we talk about other questions actually. So we talk about valuation as at the end of the day, it's still a relationship between an entrepreneur and usually investors. And we know in the VC space, usually it's very people to people type of relationship. So who do you think should pull the trigger first? Should it be the entrepreneurs to offer their own valuation? Say, look, I want this amount of money for this percentage and I will give you this percentage of my company? Or should it be offered by the investor? What would be your recommendation around who should pull the trigger, basically, in terms of valuation?
Yeah. The one who is in greater need will have to blink first. Because if you have a startup and you're really running out of money, you can have the greatest of ideas. But if you don't have money to pay salaries, your tech people, it's going to be pretty nasty, So, but if there's an investor who comes along and, is prepared to give you something that's only maybe half of what you think you're worth, then you have to weigh quite carefully whether the capital that he's bringing is going to help you see you through the next phase, and hopefully later on you can get a better valuation or not. Investors are usually people looking for a bargain. So you can be sure that they will just, bargain you down to like what they think is a comfortable level. And so as the creators of technology or IP, we would then have to really examine how badly we need that capital. So we could, for example, need investors for various reasons. The first would be that we just need the capital, to survive. The second could be that the investor is actually a client, which is quite common. The client decides that you're doing such a great job, why don't I just buy you rather than to outsource to you? Or it could just be an investor that can give you networks and allow you to travel even better, on a far greater scale than you can on your own. So the questions will have to be asked for each situation. What sort of investor that is, and what sort of value would the investor bring? Even sometimes if it's capital, does that really mean a difference between whether you're still around or not? So sometimes that's the hard question that a lot of startups have to encounter.
Mm-hmm. Perfect. I see you ask a question, Si Kyung, but I will actually just take a little. I will take these questions actually that honestly I prepared before, but I see it has been raised by one of the attendees. So we are talking, there's this big movement around impact investment, social entrepreneurship. So companies are not only about making profit, generating revenue and value for their shareholders, but creating bigger impact for the society, right? So we are talking about technology companies who deliver a strong social impact or environmental impact. We are talking about technology helping farmers to be more included into the value chains. We are talking about peer-to-peer lenders providing access to funding to serve women entrepreneurs, etc. So the question is how social entrepreneurs can actually value this social impact beyond what we discussed, right? Evaluating the intangible assets, evaluating the IP, evaluating the profit and loss, revenue profit. So do you see basically, especially in the context of Southeast Asia, a movement towards valuing social impact? If yes, how do you get to make investors understand that the valuation should increase because I'm basically doing a better business for the country or for the region?
Mm-hmm. Well, I think the harsh reality is that if you are providing a solution in the whole ESG space, and there is a big multinational that's looking, to either manufacture goods and services in a more sort of ESG friendly way, then that's a perfect fit. Then you will get the right valuation for you. But if you are going to, another business that decides and looks at it and say, well, but you are, you're costing me 20% more than if I go to someone who's not so ESG friendly, but nonetheless legit, it's going to be a hard sell. So it depends on whether you have a specific solution or not. Now, if you are just simply manufacturing with a greater, ESG profile, sometimes it's a little hard to actually be rewarded for that, because it could wind up being a little more expensive. So at the end of the day, people will still want to look at what's the bottom line to them, what's the cost to them. Yeah.
I will take the questions from Nicholas. Actually, you're using this feature, it's quite cool. You can raise your hand. So Mrs. Lim, the question is this. So we see some unicorns, right? Technology businesses, I guess we can mention Gojek, Grab in the region, or Garena. They are valued very highly, right? But despite they are still not making profit, they might have a very high top line revenue, but millions of users, but not yet breaking even, right? And then the question is, we saw WeWorks and all this valuation being challenged at one point, which created a lot of difficulties for the startup to maintain these high valuation trends and upgrade of the valuation round after round. At one point, as you mentioned, someone might lose as well, right? So, and because we are talking about companies that have such a big impact in our ecosystem, daily life, and there is probably a need for certain common standards and regulation. Right? So this is actually the questions. It's very moved from government and probably professionals associations to get some common standard to avoid this kind of huge down round of huge organizations especially impacting millions of customers like us, but also vendors they work with, like Gojek drivers, lenders, restaurants, etc.
So the free market operates on the principle of willing buyer, willing seller. You know, I used to be a stock market analyst years ago, and we were always talking about price earnings multiple, right? You know, how many times PE, how many times you pay for a company. So I had a real problem when it came to pre-revenue and loss-making companies, because you can't compute multiples on those companies. But I accept that there must be a lot of things that people see that I don't see. And a lot lies in the fact that it's tech-driven, and a lot lies in the fact that there are a lot of assumptions, and this is where the huge variation comes about. There are obviously people who are very optimistic because they see a lot more applications of the same technology. Let's say for artificial intelligence being provided. There are others who don't see a lot in it, So the ones who see a lot would then decide that I will go in earlier. Hopefully the valuations are lower. And then later on, I can decide on exiting when the company has gone up a lot more in value. So I think technology, unfortunately, brings forward in that you no longer should wait for the evidence of earnings. You actually have to start looking at the assumptions and to almost like go in faith, but some of us are a little more risk-seeking, so we can go a lot further in faith. Others like me are a lot forever also worrying about the assumptions and whether other people have been just overly enthusiastic and bullish. But unfortunately, that's the nature of technology, because unlike the traditional market, you can see if a company sets up a store, sets up 5 stores, you can track and you can follow, and before it goes into another country. Here, you can, if it works, you can scale it in one day. So you can't wait for the evidence to be there before your eyes, before you actually give it the value. You actually have to go ahead and say, I believe in the story, I believe in the projection, I like the people who are running the show, and therefore I'm prepared to pay the value. So I think it's going to be hard, speaking as a former government person, to regulate this, because you can't say PEs, because even PEs are not relevant. You can't say you can't be X time your revenues now, which is now a common sort of metric as well. It just means that it's going to be a lot harder to make the assessment now.
Sorry, Mrs. Lim, can I just maybe ask a follow-on question, since we were talking about taking multiples on your gross merchandise value or revenues as a benchmark, right, as compared to traditional ways of looking at price to earnings ratio. Do you see that as becoming a potential way of looking at market comparables and determining the valuation of these companies?
I think for technology, that might unfortunately be like the only meaningful way, because you can't wait for the profits to show up, or you'll be like quite far behind, So I think a lot of people are forced to use that, for comparisons and so on. But there's obviously the risk of falling over yourselves. I mean, in terms of being too enthusiastic, trying to justify why the multiples are fine, because you're expecting this exponential growth. So there's always that risk that you might be wrong. Of course, it's back to the whole risk-reward correlation. If you are right and you're ahead of everyone, you will be amply rewarded as well.
Interesting. Actually, I have 10 or 15 more questions, so I will try to select, but I will take the one from Sik Yong Tan. I think it's referred to angel investors, right, who are very new to investing in technology startups. I will say, so the question would be, what would be probably the two key pieces of advice you will give to any new investors when it comes to valuation, because as Sikon mentioned, valuations are so widely and very sometimes subjective as well. So what would be your two pieces of advice to any new, let's say, angel investors, part of Funded Here or Anin actually to consider? Daniel,
Right.
we can also jump on this in case, yeah.
Right. You would have, well, you might not be able to see the war scars, but we all learn from our mistakes. But I would say that I would look at the persons behind the company, look at the track record, see what they've done before, see what capabilities they have in terms of, like, for example, the wearables company that I was talking about. It's actually being it was founded by a team who were running a very successful business unit of Nokia before. So I could relate to the kind of experience, the kind of credibility and so on. And then after that, of course, you have to look at the domain space. What sort of business are they trying to do? So some people are very experienced and good, but they might be trying to do something quite out of the previous experience. Then there's of course the other alternative, in that if you still want to get exposure to the space, but you don't really want to have concentration of risk in any particular one, then you might want to diversify through an intermediary. So for example, this is just a pitch for Funded Here and Anin. You might just want to spread it out and try a few companies through a platform or through a fund that it specializes in technology itself.
Mm-hmm. And if I may add just two advices usually I practice when I invest. I agree, technology companies are sometimes very hard to value, and usually what I do is I search for advice. We all have, if you are an angel investors, most likely you have people surrounding you that are professionals, experienced investors. You have a network, right? So you should actually sort of pool, I guess, to get at least a ballpark, right? So is this the valuation are being offered by the entrepreneurs is getting sort of reasonable according to the industry standards? So it doesn't give you the exact price. I don't think there's an exact price, but at least basically, is this valuation totally insane or not? So it will give you a sense, okay, are we more or less able to bargain or negotiate the valuation somehow? The second one is valuation. For me, it has to be think long-term as well, because it has certain impact long-term on the company. A too low valuation basically put the risk that you take too much of equity from the founders, and basically there's so many risks later on that the company is not able to fundraise again, because the next investor will say, look, you guys are giving away too much of your equity. It's too risky for me. You're going to lose the majority of your business. There's no way. And a too high valuation might also create a risk that the next round might not be as generous, and we create a down round. And this is also the worst for everybody. The previous investor will get diluted, and we lose basically value. And then it's just such a bad signal to the market. So I think getting the right price is actually a very key element of the sustainability of your investment long term. So that's usually the two pieces of advice. And I will give a last one, actually, that it comes back to one of the questions asked is, sometimes I do believe valuation is too much at the center of the discussion, but there's also other factors you should always consider when you make an investment. The valuation is the price, but it comes with the, all the little details. It's like buying a house, where you have also certain terms and conditions. But sometimes people sort of don't think about, but at the end of the day, will sort of regulate your investment over time. So the question is this, what, beyond the valuation, usually what an investor, especially new, should actually pay attention before investing?
Mm-hmm. No, I think that's a great question, because I think too little attention is actually paid to how the business is run, governance. So I'm not talking about having like a full board but just how decisions are taken, key decisions are taken. Does the company keep good books? No, it doesn't have to be regular, but does it keep proper books, of its dealings? is it really running its business honestly? You know, so these are what I call the governance questions and issues, and sometimes that's extremely important, because if you have like a one-man show, then you know, you have a real sort of key man risk, and if he's not around, nobody supports the, you know, the business, then I think that's quite problematic as well.
Okay, let me pick one question. Okay, actually, so that actually could be my closing question. Daniel, let me know if we are right on time. So it happens sometimes that you don't get any agreement on your valuation, right? So you offer an evaluation to the investors, and the investor get back to you with actually something that is not even you will not even consider. So when there is no agreement on valuation, what would be the advice for the entrepreneurs or for the investor? Shall the entrepreneur say, look, I'm still going to take it. It doesn't matter. I need absolutely the money, and I'm going to take it. So, or should I just run away and find someone else? So what is better, basically, to get a lower valuation but no money, or versus actually not getting any money, right? So low valuation versus no money. What would be your...
So it can be in between. I've seen this being done quite often. You know, as the entrepreneur and the founder, I'm always very optimistic, right? And I tell you, as a potential investor, I'm going to do 3 times my revenues next year, you know. And of course, as an investor, you are like, of course, you will say that, you know, how do I know that? So they tend to have what we call carve-outs. So you can agree on a value, but if I really, as an investor, still like your business, but I don't think you're going to hit 3 times yourself, then I actually do an adjustment where if you get 2 times and I still like your business, then we will adjust the valuation downwards. You know, so some of them where they are really sort of they have an intention to actually get into a, you know, venture, they come to some agreement where it's performance related. Yeah.
Well, thank you so much, Mrs. Lim and David. I think we have come to the end of the session. For some of you who may have more questions on valuation techniques and would love to learn more about it, whether out of Singapore or Indonesia, please feel free to reach out to both Funded Here and Angin. We'll be more than happy to connect you to the right people, and even to show you some of the techniques that we use when we are assessing companies. I think this is still a very new area. We do not have a valuation standard, unlike very traditional assets, and I think this will be a work in progress. So thank you so much, everyone, for joining us this evening. We look forward to meeting all of you once again.
Thank you. Bye.
Thank you.
Thanks, everyone.